Next, I'll pass over to David Chan from MLC Private Equity. David joined the business in 2009 as head of Asia and has extensive industry experience spanning over 20 years. David actually started out his career as a software engineer and worked for Sun Microsystems, among others, Yahoo, I believe, as well. So quite a diverse skill set. But I'll pass over now to David to talk around private equity.
Great. Thank you, everyone, and good afternoon. Thank you, Russell, for that great overview onto private credit and private equity markets. I'll just take the next kind of 20 minutes to do a little bit more of a deep dive into the private equity markets. What's driven some of those changes you've seen as to companies staying private for longer? Deep dive into the mid-market. As Russell mentioned, we also see it as the most attractive space in that private equity spectrum. And then finally touch upon how you can use that in a portfolio. So the first kind of mega trend I'd like to discuss is why public markets are shrinking and why companies are staying private longer. You hear this a lot in the press. I don't think a lot of detail goes into kind of what's really driving this and what's changed about the markets that allow these companies to stay private for longer. I think regulatory setting is probably one of the first things I'll point out. The compliance costs of staying listed have increased over time. Having kind of those quarterly reporting, compliance with all the different kind of regulations that keep popping up and changing regulations, it's become very onerous on companies. And founders and businesses really want to just focus on their core competencies, all right, which is either selling a product or designing a process or service that solves a solution for customers. Being private really allows you to kind of streamline your process and focus on what's a real core competency of your business. The second one is the rise of private capital. And so while kind of we mentioned private equity is kind of this kind of motherhood statement or word which encompasses a lot of real kind of different underlying asset classes. It includes venture capital, it includes kind of mid-market, it includes large buyout. Beyond that, there's a second layer, and probably the most significant of that is really the rise of the secondary market. And so the secondary market is where investors trade LP positions or limited partner positions where you enter in a private equity fund to another investor. And what that's really allowed over time is that if you think back in the day when a founder starts a company, they get individual staff to join the company on the promise that I'll give you some shares, and then one day these shares will be worth a lot, and we'll all go IPO and we'll be happy days and you can get liquidity. Quite often 10 years later or a decade and a half later, the company's started to become very successful. The company's not listed yet, right? And then all the employees, and now there's probably like 1,000 or 10,000 employees in this company, all like, hey, we've got mortgage to pay, we've got kids in private schools, we've been on this under market salary for 15 years now, and you must go IPO because we need liquidity and there's no market otherwise for our locked up shares. But with the rise of the secondary market, which has been over $100 billion for the last 4 years, reached over $150 billion last year, you have this active market where any employee, whether you're a SpaceX or Canva, you can just go sell your employee shares in the secondary market anytime to gain liquidity. And so there's not that kind of necessity that you must go IPO when you reach a certain size. In addition, the scale of the private markets have just continued to grow. And so you see it with some of the latest AI funding rounds where they're kind of raising $100 billion at a time. There isn't this cap that says, if I need to raise X amount of capital, I must go to the private markets, because now the private markets have really become deep enough that you don't have to go to the public markets anymore. The third point here, mergers and acquisitions and really the rise of take privates. You'll see the charts, kind of the US coming down and most of the developed markets. Australia's a little bit of an anomaly in that it's been rising for a very long time and started to come down in more recent years. I think Australia's a little bit different in that we've had the superannuation system really supporting the local market for a long time. That's really been focused on the listed markets. And there's been, as you'll see in some later slides, very little allocation to private markets. As that allocation has started to shift, you start to see that trend reversing and being more in line with global trends. where the US is probably the most ahead of that curve, where you see a lot of companies being taken private off the public markets. It really increases kind of alignment with founders and management team, because in the private setting, they're able to execute their long-term business plans without that quarterly financial reporting scrutiny, but also align the economics to really encourage them to be an owner of that business rather than just an employee. And finally, that strategic preference to stay private. On his chart, you can see a couple of those reasons why private companies have become more and more options, and you can see by this increasing size of the companies and the tenure of companies being really private more than a decade now before they often consider going public. Whereas in the past, it was a much quicker kind of route to become a public company. But what you ended up with many markets, particularly in emerging markets, but you see that a bit in Australia and the US as well, we got these kind of large rump of what we call illiquid public companies, mid-market public companies, where they're a bit too subscale, they don't really have a lot of free float, there's not really research coverage, and so while they've gone public, in all effects and purposes, they really should have stayed private, because it doesn't really afford them much of the typical benefits of going public in terms of increased brand awareness, increased sources of capital, etc. They're still relatively infrequently traded, even as public companies. Strategic preference to protect intellectual capital is an interesting one. So as my role at MLC, and I've been at MLC kind of over 16 years now, we've actually seen quite a few business models, which when we've seen them as private companies, we're like, wow, that's an amazing company. How do you keep these margins for so long? And they're like, can we actually ever exit this company to the IPO markets? And they're like, no, please, never. The reason is because if our customers ever saw our margins, right, or our competitors ever saw our margins, you would suddenly get all this increased competition in that type of business. And being private and being a little bit secretive, having a business model where it's not clear to the customer how much margin they're making, it's not clear that they don't have many competitors producing this type of product, gives them a very unique advantage. And you can build up quite sizable kind of family businesses. And they're the businesses which we love finding and investing in. The second one is that new form of access of capital. So I guess everyone's seen in the last few years, as Russell mentioned, that private credit market has really grown. I think you start to see that even within the private equity market, there's been the rise within the secondary market of what we call continuation vehicles or GP-led vehicles. These are when kind of fund managers who have a bunch of assets reaching the end of their fund life, instead of selling them to a strategic or IPOing them, they're forming new vehicles and effectively selling them into new vehicles that they create with new investors coming in to price that round. And that's allowed those companies to really stay private for a very long period of time. And it's akin somewhat to an evergreen vehicle. So instead of having a 10-year closed-end vehicle, which is the typical private equity structure, by using continuation vehicles, you can kind of extend the vehicles multiple rounds and almost hold these assets indefinitely. Focusing on long-term outcomes, as well as greater control and flexibility of the business decisions as they grow. I think it's interesting when we look at private markets as well, and particularly PE, is to see what kind of the top investors globally are doing. And so if you look at this chart, you can see Yale, Harvard are nearly around 40% private equity allocation. A lot of the sovereign funds globally, but noticeably, even Australia's Future Fund has 15% allocated to private equity, whereas most of the superannuation funds, MLC included, typically have around a 5 or 6% allocation to private equity. And so if it's such an attractive asset class, and you've seen those charts before where it has the highest expected return and relatively modest volatility compared to public markets, why don't we follow kind of global standards and have more in private equity? While I think there's definitely the case that all investors should be in the asset class, and it adds a lot in terms of a portfolio context and improving that efficient frontier, I think liquidity is really something that everyone needs to be mindful of. While there are a lot of structures, evergreen structures, monthly liquidity, redemption structures that you can use today that help alleviate some of the liquidity issues that you see in private equity, ultimately having a larger percent of your portfolio in Australia is increasingly difficult for two reasons. One is our, I would say, incessant focus on fees relative to most other international markets. Australia, we really, thanks to the government and the regulatory environment, really are more focused on managing cost to serve than on pure net returns. And so a lot of the other sophisticated institutional investors globally only care about one thing, right? Which is, what is my net return? They're happy to pay the top firms globally 30% carry, right? Ratcheting performance fee structures if they can deliver certain return hurdles, which intuitively makes sense but doesn't really work in the Australian regulatory environment. The second one is really on liquidity. I think in the past we've seen situations where funds have kind of gated or closed, even when they have redemption windows or quarterly redemption windows. And so that's caused some regulatory pushback on how much you can allocate these asset classes, because we know that most private assets, if you need to sell them quickly, you'll have to sell them at 10, 20% discounts. And so they're really assets you need to hold to maturity. These assets, I think you will see this trend going up over time, but I think in Australia it will be probably a little bit more diversified than globally in terms of the type of alternate asset classes. You've seen a lot of infrastructure in Australia. You'll see more private credit, I think. You'll see more kind of private debt, different types of real assets and real return structures, as well as private equity grow over time. Why now? Private equity buyout valuations are materially below the public markets, and I think with the rise over the last year or so, particularly in the Magnificent Seven, this contrast has become more stark. Typically within our private equity book, when a company goes for an exit event, whether it be IPO or most commonly strategic sale, we typically see around a 30 to 40% uplift within our own portfolio companies when they have their exit event, which shows that the valuations are conservative. And it's something we really look for within our private equity book as investors. I think valuations is one of those topics where it's like valuing your house. Everyone has a price. Most people say, if I don't get that price, I just won't sell the asset, which is kind of similar to private markets. People think their company is worth a particular value. If you get the right comparables, you can always justify your price within a range, maybe 20 or 30% either way. But until you actually run an auction and sell that property or sell that company, you don't really have a true mark, right? You have an estimate or a best estimate of what you think that asset is worth. And what we like to see within our portfolio is a very diversified portfolio with kind of a large number of GPs with uncorrelated risks and markets, and that portfolio turning over very regularly. So we like to see ideally shorter hold periods amongst our GPs so that we can have regular feedback as to how conservative or aggressive their valuations are. The more data points we have, the more we can say, hey, this GP's been around 20 years, they've exited 100 companies, and on average, they've been at 20% discounts. So we know on average their valuations are conservative. The mid-market is where we see as, or what I actually personally call, what private equity should play in, or the true essence of private equity. So today, because of the secondary market and continuation vehicles, there are a lot of sponsor-to-sponsor trades, which is like one PE firm selling to another PE firm, like KKR selling to Blackstone, selling to Carlyle, and kind of these assets, while they may be good assets, kind of going around in a circle. The price kind of varies with the public markets, and the debt levels vary with the capital markets. And some investors make money, some investors lose money, but you're very much dependent on market beta. Whereas where private equity historically grew up and made a lot of its money, and where I think is where private equity really should play, is in the mid-market, but more specifically in helping founder-owned companies professionalize. And so I think where the true advantage of private equity is you take a business which is typically founder-backed, which hasn't had any institutional capital behind it before, right? And you help that company to professionalize its IT systems, so set up SAP or NetSuite or other systems and really professionalize its processes, introduce proper governance and boards, etc., and then put capital behind it to then scale that business, right? And that's where you can add a very significant return of capital. You can see on the chart on the left that mid and small buyouts typically outperform the large caps. But what this chart doesn't really show is the risk level. So I would say, as you've seen from the quartiling charts, the top end quartile, there's a big dispersion. In small and mid-market buyout, the dispersion is also larger than large cap, right? And so if you don't really know what you're doing, you're probably better off going into the larger end because the volatility is lower and you're still getting a good return relative to public markets. But where you can generate kind of real alpha is by looking at that mid-market or that smaller end. I'll kind of go run through a couple of the key sources of value creation or the typical parts of a private equity playbook. I think these are quite instructive because they also help inform why the volatility can be lower even when there's times of downturn compared to the public markets. The first one is kind of organizational effectiveness, being able to manage the business both for improved working capital. We see that quite often when a PE goes into particularly family-owned businesses. They never even ask their suppliers, can we have like a 3% discount because we have X amount of scale? Just simple changes like that, but more specifically, kind of optimizing working capital, trying to enhance the systems and processes, and ensuring the CapEx is spent in the right area. So we've invested in a number of consumer companies as MLC. We're never surprised these days when we walk into kind of a successful consumer company and they don't actually know which SKUs are the profitable ones or which products are the profitable ones. They kind of sell them and go, hey, we're making a lot of money. But hey, when you break that down, we've got like 3 kind of hero products which are really taking home all the margin, and they've got like 10 other products which are significant cost centers or someone's pet project. The second point is talent and recruiting. And here really alignment of interest is key. So being able to structure a management incentive or equity plan to align the investors and the management team. And so removing some of that agency problem you have in many large corporates where the employees kind of turn up for a paycheck but aren't really motivated to help grow the company. When you give individuals equity and real potential to share in the upside of the value they create, so if they generate a 3x return, they can share in 10% of the equity that's created. But if they generate a 4 or 5% return, they can generate 15% of the, or share in 15% of the equity. Suddenly you see kind of that spark and that motivation. And a lot of the firms, particularly in the big end of town, you've seen implement this in what we call broad-based employee option schemes. So KKR has been one of the big advocates of that in recent years, but we've seen that a lot more across the industry, recognizing that benefit of having all employees participate in that upside. Expanding into different markets, being able to really drive revenue behind the right products, as well as M&A are some of the kind of other key value drivers. Here we just run through a chart of the different levers of value creation. I think private equity gets a bad name that quite often people think it's just financial engineering and it's just public markets with a bit more leverage on top, particularly in the mid-market. But overall, when we look through the data, generally leverage counts for less than a third of the value creation for most private equity deals. Within our MLC book, it's actually kind of a negative contributor. I think that's just the time period that this data was taken over. It was in a period where companies were quite levered when we entered into the companies and they had to de-lever over time. Because the equity markets and the leverage markets became more tight. I think going forward, you'll see that return to around 20-30% of value creation will be from leverage. Particularly these days, kind of leverage, especially for mid-market companies, is quite hard to come across. And so those which are able to get some leverage from day one typically are very high quality companies. Multiple expansion, while it does get a bad rap, quite often that's really a core value driver for mid-market companies, because one of the key things you can do when you buy a mid-size or small business is really scale it to the point where it can become a larger cap or larger size business that can then list or be attractive to strategic acquirers. And then when you'll be able to do that, quite often we'll see a multiple re-rating of 2 or 3 turns. And so if you think of the businesses that a KKR or Blackstone will buy, they're typically trading at 12 to 18 times EV to EBITDA, whereas most mid-market companies we'll see in our portfolio trade for high single digits, so somewhere between 8 to 10 times. The trick is how you then grow that $100 or $200 million business to be more like a $800, $900, $1 billion plus business. Finally, I'll just touch on quickly portfolio benefits and what we've seen in our book. These are the relative returns of the MLC portfolio in yellow in the private equity asset class compared to the MSCI All World. And you'll see kind of this consistent outperformance over long time periods, so 5, 7, 10, 15, 20 years plus, consistent kind of 4 to 5% outperformance of public markets. I think this is characteristic of kind of a well-run, mature program. In the short term, you will see more volatility, and there will be years where it'll underperform public markets, particularly when public markets are having very bullish years. But over the longer term, you generally will see private markets outperform. I think consistency is a function of two things for MLC. One, consistent investment, and the second one is diversification, both across vintage year but also geography and different industries. I think one of the big mistakes that some kind of our peers and others in the market do when they enter into private equity, they're like, hey, this is a great asset class, it's got really kind of attractive risk return, let's put in like $1 billion this year, right? And then next year the market comes down and their book is not looking so great, and they're like, oh, maybe we should deploy zero, right, this year, or maybe we should even pull out of the market and sell some assets because we're overweight or overexposed. And typically what happens is you end up kind of mistiming the market and entering at the worst times and selling at the best times. And the reason is what we call like the denominator effect. When the public market book runs really hot, when the markets are typically frothy, you have more kind of nominal NAV. And so when you allocate kind of 5% of your book to private equity, it's quite a big number. And then when markets collapse, your percent in private equity looks significantly overweight, and then you're encouraged to sell. Fortunately for us, we've had very supportive boards who've understood that dynamic, and we've been very disciplined to stay kind of underinvested when the markets are bullish. So we're kind of fully invested when the markets run the other way. Finally, we can see kind of this is an example of that efficient frontier and how private equity, you're adding somewhere between 2% down the bottom up to around 6 or 7% to the top of the chart, has improved the risk return profile. And this is actually MLC's own numbers across all our different portfolios. We've actually had the state, because of various mergers, we've had some of our books which didn't have private equity, and others running exactly the same strategies where private equity has been added. And you can see the benefits that it can produce. Generally an increase in returns of somewhere between 0.1 and 0.5% across the various time horizons, while minimizing the expected risk or loss, which I think is a great outcome for investors. All right. Thank you so much.
Thank you, David. Just any immediate questions for David? We have got a few. David, running ahead of time. We have got a few moments if anyone's got any immediate questions.
So, David, you talked about examining the companies you invest in. I mean, what level of so presumably you're using underlying GPs to source those companies. I mean, what level of transparency do you have to where the money is actually deployed?
Yeah, the transparency has increased a lot over I've been with MLC, as I mentioned, 16 years. I think for buyout transactions, the transparency has always been very high. So you always get a full set of financial due diligence report, legal due diligence, commercial due diligence. These days, we typically also get ESG due diligence, and because everyone's so risk averse on cyber risk, we often get tech due diligence as well to see how strong the platforms and the technology is. The buyout side has always been quite good. As I mentioned, the level of due diligence has only increased over time. Where we've seen kind of the most marked changes is in kind of the venture capital world. So that used to be quite secretive. I remember when we first invested in some of the top tier US names, they wouldn't tell us what was in our book, which we thought was quite ridiculous because we're investors. But they were so hard to get access to, you kind of were lucky to get an allocation. And so you're like, thank you for us getting in. We'll kind of figure out what we're investing in later, but we're generating like 30% returns. So I guess while we keep doing that, everyone's happy. But about 10 years ago, with increasing regulatory scrutiny, both in the US with the Freedom of Information Act and then in Australia with public holdings disclosure, that became quite a strong push from all the investors to actually kind of have a lot more disclosure. And we suddenly saw access to data rooms, which ironically we never had when we first started investing in some of these venture funds. But over time, we've seen that kind of expand to what we would call a very transparent level of due diligence. So not only do they tell us all about their holdings now they have portfolio workbooks where they'll display all the financials of all the companies, where they exited at, how they're tracking. We'll get access to monthly budgets or quarterly budgets, and then reconciliations against that. And so these days, it's probably very equivalent to what you would see, if not better, than the public market books that we run at MLC.